Sigue entrando gente al seminario, les vamos a dar un par de minutos más. En un minuto más vamos a partir la presentación con Paul. Así que esperemos un ratito, dale. Okay. Excuse me, Paul, I will do a brief introduction in Spanish because all our audience are Spanish speakers. So briefly, just to let you jump in with the presentation. Hola a todos. Bueno, como todos saben, vamos a tener una entretenida conversación con Paul. Un ratito, una hora, tenemos un horario bien estricto. Y probablemente muchos de ustedes conocen a Norges, conocen lo que hacen, no todos necesariamente, y por lo mismo que me gustaría darles una pequeña introducción en cifras. Bueno, como muchos sabrán, Norges es el fondo soberano de Noruega, es el fondo soberano más grande del mundo. Hoy día administra cerca de 1.3 trillones de dólares. Es cercano a 7 veces lo que administra todo el sistema de pensiones chileno, ¿ya? Después de los rescates, ¿ya? Hoy, solo para que tengan una noción, la población de Noruega son 5,3 millones de habitantes, un PIB per cápita cercano a 75.000 dólares, lo cual lo ubica claramente dentro de los el ranking top 5 a nivel mundial, y la evolución del PIB per cápita ha sido exponencial. O sea, la verdad que desde el año 90 a la fecha han crecido cerca de 4 veces, ¿ya? Y coincide más o menos con la creación de este fondo, ¿ya? Lo cual tiene características que obviamente Paul nos contará, ¿ya? En términos del índice de Gini, hoy día muy de moda, también está top 5 Noruega, y aquí queremos un poco indagar lo que nos puede contar Paul respecto a lo que ha hecho el fondo relativo a este tipo de cosas. Hi, Paul. I will turn to English in order to have a nice conversation with you. Thank you very much for this conversation, for this interview. First of all, as I was aware, thanks so much to Moneda Asset Management, to Sartor Finance, Finsa y Scotiabank, nuestros sponsors en el CFA Society de Chile, el capítulo chileno. Today we have Paul Marcussen. Paul, he is CFA charter holder. He's the head of the office of Norges in New York. He's a master in finance in London Business School. He has a huge resume, so we will jump in with the presentation, which I think it's much more important for everybody to understand, okay? Hi, Paul. First of all, if you can tell us a little bit about Norges, briefly, what is the fund and the main topics of the fund, okay?
Yeah, excellent. So I've prepared a couple of slides, so maybe we can go through that, and then we can do some discussion afterwards. So let me see this to get this to work. So essentially, the fund, which in Norwegian we tend to refer to as the oil fund, which has nothing to do with oil per se, other than the fact that the income came from oil. So Norway discovered oil outside the in the ocean on December 23rd, 1969, and it came after a number of failed attempts, and they finally found it, and it was a big celebration. And then essentially for the first couple of decades, they decided that the government should have a big stake in developing the oil sector. So all the revenue they got from the oil sector was plowed back into building new platform, building up new fields, and etc. So there was no cash flow per se that went into the economy. And then early 1990s, they realized that there was not that many more investments, and they were going to have this massive free cash flow coming to the country. And Norway, like Chile, is a long, thin country with not that many people, and the amount of money that was going to come in could potentially create a lot of inflation. And the central bank, which we're part of, among others, said that that's not a good idea because it would make the rest of the industry uncompetitive. And while there might be some money in the bank account, there'd be a lot of unemployed people, which is never good for social cohesion. So what they decided was to set up a fund, and essentially, just move this. Essentially, what it does is that it takes the oil revenue from the North Sea and sells the oil, you sell the oil abroad, keep the money abroad, and just invest it in the fund. In one sense, all you've done is taken the value from up underneath the ground and put it into a fund. You have neither become richer or poorer from that exercise. The value comes when you spend it. So over time, we have actually moved from having more wealth underneath the ground to having more wealth in the fund. Part of what's made us successful over time is sort of a clear segregation of duties here. So the parliament on top, which sets the laws and regulations that governs us. Then you have the Ministry of Finance in the middle, which sets the guidelines for the fund. And then Norges Bank on the bottom, which manages the fund. On each level here, there's a great deal of transparency and there's audits. And it's very important that there's a trust in the people and that there's an easily understandable process here. We can only operate as long as people let us operate. And that happens when people trust in what we're doing. Over time, when I started, the fund was very small. It has had massive inflows. But today, there's more, these numbers are unfortunately in kroners. But today, there's more than twice as much of the value of the fund is from the return than was actually ever put into the fund. So the dark blue area here is what's the net inflow over time. So you see they've taken money out the last few years from the fund. The fund has gotten very, very big. It's $1.3 trillion, which is more than 2.5 times local GDP. The way it's managed, it's called the pension fund, but it has really nothing to do with pension. It's more like an endowment. We take out 3% of the fund, or the target is to take out 3% of the fund, which gets put into the general budget. And it now, last year, covered 25% of the national budget. As you can see from the green line, it fluctuates a little bit above and below the target, but the politicians have been quite good at sort of sticking to the target. And that might be the most impressive part of the entire story, to be honest. Politicians have always have things to solve, and this was money in this fund, and they still kept their discipline and kept the taking out the money very cautiously. By the way, the 3% target is equivalent to our expected real return of the fund going forward. In terms of what we invest in, it's kind of a very classical portfolio. The majority of the assets are in equities. Target is 70%. Then there's fixed income, 25 year end, and there's a couple of percent in real estate. There's a new asset class, which we've only done one investment so far, which hasn't closed, which is unlisted infrastructure. But you can see from this that there's no venture capital, there's no private equity, etc. So it's a very, very traditional asset mix. We buy a very broad portfolio of stocks. So when you manage this amount of money, there's really only one thing you can do, and that is really index a big chunk of the portfolio. And we have a pretty broad benchmark. So we've bought about 9,000 companies globally. On average, we own about 1.4% of those stocks of the 9,000 companies. And you can see here some of our biggest investments in blue and the percent of those companies that we own. And I also included some of our biggest investments in Chile on the bottom there. So we own 1.1% of Untitled Chile. In the emerging markets, including Chile, we use local fund managers to manage money for us because we believe in the local expertise and the local knowledge. As responsible investments is very important for us. And from our standpoint, it's what the people want, and the people own the fund. And therefore, we have to deliver on this. And we set it basically in 3 areas. It's setting standards, like reporting standards and other things. It's exercising ownership through dialogue with companies, voting, etc. And we also have some money set aside for environmental investments, and we divest certain stocks, including coal-based utilities. Transparency is very important. As I said, there's $1.3 trillion in the fund. Interestingly enough, our website updates the value of the fund 16 times every second. So there's never any doubt how much money is actually invested in the fund. It is, in one sense, a useless exercise, given that we're very long-term time horizon. On the other hand, it just shows that we're very transparent. We publish everything we have voted for or against. So here in this case, I've pulled up the annual meeting from Untitled Chile, and you can see what the management recommended and what we voted. So we voted for most of the cases, except for one where we felt like we didn't have enough information to make a clear judgment. So how's it gone since the beginning? So if you see since inception, basically the benchmark is about 6%, portfolio 629 before costs. And then there's inflation been 172, and basically net return in real terms has been 4.42%. Last 5 years, it's been a little bit higher. I've also included sort of the management cost here. And the reason for that is that in order to sort of keep the faith in the population, we have to run a pretty tight ship and quite low costs. So basically, we manage the fund for about 5 basis points per year. So that's
really low. That's really low.
It's very low. It's very low. I mean, of course, it's helped by the fact that a big chunk of the assets are in essentially a big index fund.
Great. One point maybe, Paul, that it's good to highlight. You mentioned about the transparency. As you know, in Chile, it's impossible not to compare. This is a sovereign wealth fund, but we have the pension fund system. So locally, the society in some ways is questioning the mandate for the pension funds. I don't know if you can talk a little bit about what the fund has done, not more than the transparency. What have you done something to educate the population, or something that permits that the population feels the fund it's of their own, or something like that?
Yeah, so we spend a lot of time informing the population in Norway about the fund. So there's always people out visiting universities and other places to explain how it's set up and how it functions. And then the other thing is sort of the parliamentarians, or the people's representatives. We regularly have them come into the fund and explain what we do, and try to be transparent, and show them around the floor and explain the benefits of it. Of course, they also see the benefit in the fact that they can make a budget more easily.
Great. It's funny what you mentioned about the structure of the fund, but because everybody, I don't know, when take a look at, I don't know, CalPERS or the big players or the big sovereign wealth funds, most of them have a big exposure to alternatives. If you can explain a little bit further why, in this case, Norges has not that much invested on that type of investment.
Yeah, so we started out with being pure fixed income in the beginning, and as the fund grew, we sort of added different fixed income asset classes, and then we added equities, and then we added emerging markets, and then we added small caps. So we kept expanding the universe, and then real estate is the last asset class that we've sort of added a few years ago, that we have some investments in, and now we've added the environmental side. On the private equity side, there's been a lot of we're very, very reliant on the academic side, the university side, in terms of advice. They've often felt that the private equity side, there's a lot of fees associated with it, and that essentially you can get a similar return in the public equity markets. And in one sense, our equity share of 70% is quite high. And in a sense, they've compensated by increasing the equity share instead.
Oh.
And it should be said that we have multiple times requested to be allowed to invest in specifically venture capital. So if you think of sort of a life cycle of a company, you start out as a young startup and early stage, and then eventually when you get bigger, you list on the stock market. So we only capture part of the life cycle of a company when it's on the stock market. So we've requested having a venture multiple times. The issue the Ministry of Finance has with it is that for them, it would be less transparent. They would see less of our investments, and they couldn't request annual reports. It'd be less transparent for the overall population to understand what we're doing.
Great. Good point to highlight. It's something that nobody, not too much people take a look into. I think it's evolving, but it's important to have that angle. Maybe it fits in here in the sense that the structure of the fund and the governance is very, very important, because that's sort of like what buys us the stability and sort of the staying power.
that keeping the trust. So therefore, the transparency is like truly ingrained in the way we do things in order to sort of like, be able to keep going. And yesterday was our 25th anniversary for investing money, so it's lasted for a while.
Congratulations.
Yeah.
Do you have any I don't know, survey or index? How is the fund perceived by the Norwegians in some way?
So we do a lot of work on that, and we do send out surveys, and we ask questions. What's your perception of the fund, etc. And it has a high ranking in the country, and people feel like we're doing a good job. And which is great. The issue is kind of like when you start asking, do you understand what we do? And that's kind of where we need to do more work, because there's still some, even though we try to make the investment strategy quite straightforward, there's still some questions of how is it implemented, how does it work? So it's continuous work.
Good. And Paul, maybe if you go to more traditional questions, maybe if you can talk a little bit about the investment process. How do you do the asset allocation and the risk? We discussed in a previous meeting that you have a particular way to offset some risks. Maybe if you can deep dive on that.
Yeah, so when it comes to the allocation side, we stick quite strict to sort of the benchmark allocation that we're giving by the Ministry of Finance. In other words, the 70% equity. And then we have an automatic rebalancing rule around that. So we let it slide. You can see today it was 72 point something. Once it gets up to that level, we start gradually rebalancing back towards 70. So on the allocation side, that's a very sort of slow moving, steady item, and we don't take big viewpoints on that. And it's kind of based on the fact that we don't want to destroy the returns by one or two bad decisions on those big pictures. And what you're alluding to, which is also quite interesting, we're very afraid of having committees making decisions. And there's essentially two ways of managing risks. Either you can have a lot of people in the room and a lot of eyes looking at each investment and do it by committee and voting and that kind of thing. That's a way of managing risk. We believe that you can very often end up with sort of the least common denominator decision if you do it that way. So what we've done instead is sort of split the fund up in many, many small subunits internally. And then we set individual people in charge of parts of that portfolio. And so we manage the risk by sort of spreading the decisions across many people.
Great. That's a little bit different than the way that at least the institutional investors here in Chile do it. In some way, we have a kind of CIO who make the decision of the beta of the portfolio, and the rest of the decisions are aligned to that. But it's a little bit different than what you are mentioning. So it's quite interesting.
Yeah, and I think it's quite unusual sort of on a global basis. I don't think many people do it the way we do it, actually. And it's brought very low down in the organization. So there's many sort of like people that have ownership, not only of portfolios, but also like systems and processes, and etc. And if it goes great, we know who to thank, and if it goes bad, then someone has to explain.
They know where you live, so
they know where you live. That's right.
Okay. Maybe on the investment side again, if you can talk a little bit about these big trends. So what about ESG, for example? How do you put that into practice in the portfolio?
Yeah, so it's very important for us. The way we do it in practice, our preferred way would be to have a dialogue with the companies. So we're very active in terms of our voting in our own ownerships, and then dialogues with the companies. So we try to reach out to the companies, discuss it with them, and we try for them to have plans of how to sort of achieve, for instance, carbon neutrality, etc. So what we do in practice is we have a big ESG database, which we do a lot of screening work, etc. And then we approach certain sectors and focus on those. So lately, we've been focusing on the steel sector and the cement sector because they emit a lot of CO2. And talking to management, coming up with ways they can, offset that over time, different ways of managing it.
Great. It's a kind of counterintuitive because, as we were discussing, Norway, in some way, all this wealth comes from oil. So yes, this is in some way turning the whole picture. So I don't know how you manage that. For instance, you have that wealth that comes from oil, and I don't know. You have said that I don't know, that investments related to that. How do you manage that? Or you are forbidden to invest on oil?
No, so we've excluded some of the oil stocks, and we've excluded sort of the pure E&P stocks from the portfolio, and we sold out of those. But we still own the integrated oils. Sort of early on, there was a goal of the Minister of Finance and the politician to keep the management of the fund very, very separate from the political decisions and the structure on the economy. So it was kept very sort of like a global index fund or a global independent arm of the government. But over time, we've realized that we have a lot of oil underneath the ground, so why should we buy more in the stock market? So we sold out a little bit. And we've had discussions around this with the Chilean Sovereign Wealth Fund on their approach to it, which differs greatly from us.
Okay.
And both are sensible. It's just trying to achieve different perspectives.
Sure. Good to know. Good to know. In the meantime, I would tell the audience, if you want to ask any question, please feel free to write them in the chat box, and we can tell it to Paul. Okay, and going on again to investments. You are, I know the fund belongs to Norway, but you have a lot of teams abroad in a lot of offices around the world. If you can tell us which is the angle of that, which is the expertise, or what are the benefits, or where, how has changed the way that you manage the portfolio related to that?
Yeah, so we started out first by opening an office in London when the fund was started, and there was some that was in order to sort of access talent in London. Norway is a very small market; it's limited with talent in terms of the financial industry. So it was really to hire more people. We've become very sort of like global integrated. So I can take my laptop from the New York office and I can travel to Singapore and open it there, and I'm automatically hooked up to the Wi-Fi there, and everything's set up. And the team structure is also set up very globally. So a lot of people have like one member sitting in Shanghai, and one member sitting in London, and one in Oslo. So we've really been working on like a virtual basis for a long time. I mean, now we've all gotten used to working on a virtual basis, but we were doing that for many years ahead of the pandemic.
That's great. You know, I ask you that because, for example, the pension funds, we are huge here in Chile. They have a different approach. They I don't know, they invest through third parties, but they have their offices and their teams locally. So that's why I would like to understand, or to know, or the audience to understand the angle on that.
Yeah, and part of it is that we decided quite early on when we realized the fund was going to get quite big. And this was back when oil prices were going up sort of like, 70, 80, 90, and then eventually up to 120. We decided to take the index management in-house. So we're doing all the index management in-house. And that means that you own a lot of stocks that you manage internally, which meant that we had to have trading desks. And we realized that we were treated much better in Asia if we had a local trading desk than if we did it from Europe. And the same thing with America. So the US office has actually existed for a very long time, since 1942. It was tied with the central bank part of Norges Bank. So we expanded that to also do equities. We had always done fixed income for the foreign exchange reserves.
Okay, good. And I'm going to maybe to the juncture. I don't know if you can talk a little bit, because all this pandemic situation has impacted the world in a huge way, and all this the managers that manage the savings in some way had been impacted, and there's a lot of politicians trying to take a little bit of it. Indeed, today in Chile was a proposal from some politicians to withdraw 100% of the savings accounts in the pension fund system. So how has been the case in Norway? How have you managed that in order not to be exposed to that?
Yeah, so I think the core behind that, and that's probably the most impressive thing about the whole fund, actually, that they haven't spent all the money. And the politicians we've been blessed with really good politicians that are very sensible. And essentially, there's two blocks. There's a left wing and a right wing in Norway. And for the fund, there's been a broad agreement among them on how this should be managed going forward. And that meant that when you had a change in government, it didn't lead to sort of massive changes in the spending plans. And this sort of 3% spending the real return there was a lot of discussions among all the parties before they agreed on that. And when they go above it, there's a lot of talk in the press about it. Of course, during the pandemic right now, they have gone above it and they have taken out more money. But they're even today talking about bringing it back to the level it used to be at.
Okay, so they're pretty serious type of guys.
Yeah, and it's we never split it up in individual accounts, so it's not like it's in someone's name. So people don't view it as their money; they view it as the government's money. So they view it as meant for not only this generation but future generations. So if you're going to spend it, it should be for something that benefits the entire population in a sense.
That's an important difference from what we have here in Chile. I don't know if that's depend on the, I don't know how educated or how the people see the long run of the country. I think it's not an easy decision, I think.
No.
Again, about the juncture, when I was doing the preparing this interview in some way, I wonder that Norway is one of the few countries that they have a wealth tax. I don't know how has indeed that is being discussed here in Chile and has caused a lot of noise. If you can talk a little bit about that, how has impacted the investments in the country and things like that? How do you see it?
So we've so I don't really have a view on taxation in general, but I can tell you from personal experience how it's worked. So it's been in place for many years, and in the sense that it does of course mean that more wealthy people have to pay more than less wealthy people. So in that sense, it's equitable and fairly distributed. There are of course issues in how do you value things, but it's easy to sort of do to homes, it's easy to do bank accounts, it's easy to do stock accounts, and it's quite easy to do big ownerships in companies. It's not, it functions quite well because there's the percentage number is not very high. It's just slightly above 1%. Okay. And there's a free amount of I guess in dollar terms about $150,000. So there's a fair bit of people that don't get hit by the tax, and it gets viewed as quite fair. There's a lot of discussions in Norway around it. Always, there's different viewpoints. I think it's generally well accepted, and there's a reasonable discussion on it.
Okay, good to know. There's a bunch of questions that are coming, so I will start with some of them, and it's related to the attributes that you look when you pick a manager. Which are they? I don't know. The most relevant ones that you look for when you are picking a manager.
Yeah, so we primarily use managers in equities and in emerging markets. The key aspect we look for is essentially the research process. Is it differentiated? Do they do something different? Strangely enough, we don't even ask for the performance record of the managers we select before we hire them. So we purely focus on how do they pick stocks, how do they do their research, who do they meet with, and that kind of questions. And of course, the overall structure that they sit within is something we look at. Also, we have a preference for boutiques and smaller managers as opposed to big funds. And that might be a result of working for a big company ourselves. So.
Oh, great. Good to know. Good to know. But in some way, each manager that you pick offset the other, or it doesn't matter if they have the same philosophy behind?
So we try to pick managers with slightly different philosophy, and it's not sort of we have boxes to fit into, but like in the overall picture, we try to have a spread of different approaches to it. So it's not like we only have value managers or only growth managers. There's a mix. Of course, they buy individual stocks, and sometimes one manager will be long and one will be short, and they'll offset. And we're okay with that in the sense that just probably means that it's an unclear situation, and we probably shouldn't have a position.
Great. Here's another question related to the compliance side. What about the compliance? There is one team in charge of the control of your several funds, or I don't know, it's centralized. How does it work?
Yeah, so it's centralized. So we have a compliance team. That's a compliance person in each office internally, and they also help oversee the compliance of the external managers. Of course, when we hire external managers, it's very important that they also have a compliance function that is well set up. That's probably been one of the challenges during the pandemic with the managers. Ensuring we've all been working from home. It used to be that the compliance officer could walk around the floor and say, "What are you working on? What risks do you see?" And that kind of process. Much more difficult when you sit remotely, and then it's less communications. But we've offset that with having more automated systems tracking. When do people trade compared to announcements? And that kind of thing.
Okay, good. Here's another one related to the fund. How do you manage to separate the fund governance from the political cycle?
Yeah, so there was one quite brilliant choice they did early on, which has truly helped us. And there's one country in the world we're not allowed to invest in, and that's Norway. So we have no investments in Norway. And that has sort of prevented sort of a big line of people knocking on our door asking for money on miscellaneous projects. So it's let us just focus on the investment side. So it's there are pressure on us to do more, say, green investments and other things. But the Ministry of Finance, which is a very, very highly qualified people, have been quite clear that we need the primary responsibility is really return for future generations. So yes, we can do ethical investments. Yes, we can do green investments, but only if the return sort of like justifies it.
No, great. That's a good way to take out the populism from the decision-making process.
I mean, it's a big risk. It's a big risk. I mean, society always have problems to solve. Even Norway is a quite rich society, but there's still problems. And keeping people diligent and in line is a big challenge.
Okay, here we have another question related to the how do you invest. In Chile, we also depend on natural resources. Do you think your model should be implemented in countries rich in natural resources with financial surplus, especially?
It's useful, especially to take away sort of like the peak prices. So the risk in the resources countries like Chile, like Norway, is that you have a boom in natural resources prices for a while, but big revenues for the government, and they start programs, etc. They can't afford during downturns, and it's not like you can hire and fire nurses and teachers based on the commodity price. So it can be very useful to smooth the cycle. So let it enter the economy slowly over time. I would say that that's sort of like one of the primary uses of it, and why it was set up in the first place. Interestingly enough, if we hadn't set up the fund and you let all this cash go into the Norwegian economy, what that would have led to would be basically a much massive growth, much stronger currency, etc. And essentially, the central bank would have to defend the currency eventually anyway, and that would have led to the foreign exchange reserves having to be built up anyway. So it would have ended up in the central bank anyway as huge foreign exchange reserves.
Clearly. Good. And this again on the investment side, which is because, as you mentioned, all your decisions in terms of equity at least is a bottom-up approach. But what do you expect in terms of long-term returns on equities? Precisely on what's going on right now. Some regions are expensive related to their own past. What do you expect on that, or what do you look for?
Yeah. So on the total fund, sort of the way our last sort of like work on it, basically we expected 3% real, which doesn't sound like very much, given that we have 70% equities. So it also tells you that the expected return on equities is quite low, and of course we know the bond yields are quite low. So our expected return forward is quite subdued.
Sure, clear. Here we have a question related to the oil industry. How does it work in Norway? There are just private players, and the state collects and rent that through taxes. How does it work?
Yeah, no. So it's a mix actually. So there's a oil company. Well, now it's listed, but it used to be unlisted. Equinor. which is the big, so it used to be called Statoil. It used to be a government-owned entity. So they invest on the behalf, and they still owned majority by the government. They are involved in the oil sector, have some of the fields, and then you have private players like Exxon and Conoco and others that operate fields. And then there's actually a third leg, and that is something that people don't really know about, but it's called Petoro, and that is a government investment in oil fields business. So they don't operate anything, but they own 20% stakes in certain fields, 30% stakes in other fields. And they basically just, they've invested alongside everyone else in terms of buying the production equipment, etc. They don't run anything. They just sort of gather the dividends or the cash flows from those fields. And then on top of that, of course, we heavily tax the oil industry.
Okay. How much is the tax?
Like it's very, very high. And I know Chile has quite high royalties on the copper side, but this is way beyond that. So the tax rate is about 80%, 80%, on the net, more on the net level or the cash flow level. The way they've essentially come up the calculation in the background is sort of, you need to incentivize people to invest. So people have to be able to make a return on investment for the investment they're making in the fields. And then if it's above that level, above a reasonable level with sort of cushion, then the remainder should essentially go to the people, which is sort of represented by the government.
Right. Clear. Here's another question related to the same topic. It's related to international oil companies with resources and experience were given license to search for oil, but the Norwegian state remain in control. What does it mean to maintain control of petroleum resources and how it's achieved?
Yeah, so we kept a license regime, and we kept giving out regimes along the way. But it was very clear regulations set locally, and that's what we mean with remaining in control. And there's different ways of sort of taking revenues from these fields. One way is, of course, for the government to operate them themselves, and a different way is through taxation. And we decided to just sort of get revenue through taxation, and then let the individual companies, private companies, operate under very strict guidelines.
Clear. Here I have some questions, more questions related. It's different topics, or let's go to what's going on right now in the markets. Maybe if you can tell us a little bit how do you see because again the S&P, it's a little bit in the close to their peaks, but there's a huge discussion about inflation in US. Which are the main risks or the main opportunities that you are seeing globally right now?
Yeah, so we're not very different than other people on this front. Inflation is what we're watching right now, and if it's transitory or more of a permanent thing, it's in a sense it's too early to tell, and it's something that's what we spend most of our days looking at. Are there signals we can draw from this, and that is our key concern in a sense. And other than that, we're more interested on the company level in a sense, is sort of being positioned rightly across the companies.
But it's amazing what we discussed in the previous meeting. It's about the way that you have to control those risks. So in some way you are a long only investor. So if you're seeing that, you're exposed, so you have nothing to do about that. So it's a little bit awkward to I don't know, to see the equities expensive, maybe real rates are really, really low. How do you offset that? How you protect yourself on that?
We're exposed to it. I mean, we'll behave like the market in many ways, given how many stocks we own and how broadly diversified we are. So we're exposed, and it's very, very difficult to hedge out in any instruments. But it also depends how you view risk. I mean, the risk for us is really that the money is not in the fund when we need to spend it, which might be sort of generations from now. So what really matters is not sort of the risk if the fund goes up and down the next 12 months, but really sort of like what's the long-term return.
Sure.
And part of the we disinvested from coal quite early on, and yes, that had an environmental angle, but it was also tied to the fact that we didn't see this as sort of a future-proof industry, and we didn't see the future for the industry. So that's also part of why it was taken out.
Great. What's your view on that? That would be good to know.
On the energy side,
Yeah.
yeah. I think you've seen it with some of the power auctions in Chile. You know, some of the renewable side that's coming in is coming in quite low compared to some of the installed capacity. And I think that will just continue, and they'll continue to have better technology, more profitable fields or opportunities. So I think that will continue. So I think some of the old forms of electricity and power will struggle longer term. Some of them are protected for a while with contracts and other things, but those eventually run off.
Good. Here's related to question. This goes about the portfolio. What's the maximum deviation from the target asset allocation that you have? You mentioned about 70% for equities, but you can, and right now you're 72 point something. How do you manage that, and how deviate from that threshold are you?
So there's no max, there's no hard max per se. It's more that when we reach a couple of percent above 70, we start rebalancing back into fixed income. And then we keep going until we get closer. So theoretically, you can keep selling equities for years and buying bonds for years, or the other way around. But it's very gradual, and the rules are not public because it can very easily lead to people trying to front us, etc. On it. But essentially, it's a couple of percent above and a couple of percent below, and then we start gradually moving.
Good. And related to ESG, there's some investors that take that approach and they invest in something and they avoid another sectors, but there are another ones that in some way influence the governance or do some, I don't know, active management on the companies where they invest. Do you do something like related to that, or just split the decision in avoids or let to invest on
let
that?
live? No, it's our preferred way would be sort of dialogue with the companies, and if we can sort of turn a bad company into something more sustainable for the planet, that'd be the best of all things. Occasionally, there's quite obvious that you can't do that. I don't think you can go to a tobacco company and say you should stop selling tobacco. I mean, it just doesn't work. So in some cases, we decide not to invest in it at all. But the preferred way is being in dialogue with management. The pure activist things in terms of coming with very harsh suggestions is a little bit difficult to do when you're a government. You very easily get blamed for interfering in other countries' governance. So we prefer to take that kind of stuff behind closed doors with management and get our viewpoint across that way. But of course, we're very active in voting on proposals from other people, and if we think something makes sense that someone else proposes, we will support that.
Okay, so in some way you give a second chance to the company to redirect their decisions, the way to say it in some way.
Yeah.
Great. Here, there's a bunch of more questions here. One is related to the investment guidelines. How often do you review them? Do you have a kind of on-site? Do you meet with the team on January and project or forecast the year, or you have a horizon of 5 year, 10, or how we will invest and things like that?
So the investment guidelines gets adjusted sort of ad hoc occasionally whenever there's a need for it. The most common adjustment is there's a new company that gets excluded. So that's sort of a minor change in sort of the exclusion list. But they tend to be quite stable over time. A few changes. There's some interesting aspects of our external managers. They all manage assets for us in segregated, separate managed accounts. So we don't buy any funds. We just have segregated accounts. Interestingly enough, in the risk mandates or the risk limits for the fund, there's no maximum risk. There's only minimum risk. So our biggest risk in a sense is that we pay active management fee for an index product. So we're very, very concerned that managers don't take risk. So when we buy a product, we want them to be active and truly active. And then so then how do we manage risk? Well, we manage risk because we have 90 different external managers, and there's very low correlation between those managers, and that lowers the total risk a great deal.
Okay. It's good way to say it. It's but it's tough to have active managers because you mentioned the fees is really low, and as a global point of view. How do you have that? How do you discuss that? You start with a point and you manage in the future. How? Because you have in the past you have 5 basis points of cost. That's really low.
Yeah, and of course the external managers are much more expensive than that. So about 5% of the fund is managed externally, and 95 is internal. So the external side we pay more than that, and we're a fair chunk of the budget. The external manager too. even we're close to half the cost of the fund, and we only have 5% of the assets. But we've had more than 50% of the return.
Great, good. Here's a question related to ESG again. If you can give some examples where your ESG process have make you sold some positions, or to force the managers that you hired to sell that position.
Yeah, so an example, for instance, in what should I say? Brazil, for instance, we've sold out of Vale, which is of course a very big stock there, and that happened in after the dam accident they had last year. And essentially, it was just we went through the risk management that they had in place at that time, and figured out that it was not strong enough. We ended up selling the stock. Afterwards, the company has done a lot of changes and a lot of improvements, and it's something, is being reevaluated continuously. Should it be let back in? But in that case, we had to tell our external managers that you're no longer allowed to own it.
Okay, good. This is a more political question, I think. This is related to Chile. Here is the question. You mentioned that the Sovereign Wealth Fund has been investor in Chile for a long time ago. Which are the main progress that you have perceived in the country in that period, and which are the main challenges for Chile from your point of view?
So the main difficulty as a foreign investor right now is the constitutional assembly going on, and sort of like what rules are going to apply going forward. I have actually every faith in the Chilean people and the people they've selected that they'll come up with something that's reasonable and that functions well. So I'm not massively concerned about it, but it's of course a risk because it's a change. In terms of changes over time, I still view Chile as one of the best managed countries in Latin America. We've had many meetings with the central bank there. Very high quality, smart people, really on the ball, manage inflation very well. Even though I understand that some of the population is not happy with the pensions fund system currently. It was a path-breaking process to begin with, and it's partially been copied in the Norwegian pension system and Australia and many other places. So overall, I think the economy of Chile has been managed quite well. As talking as a foreign investor to the country, on the other politics of the country, of course, I don't have a viewpoint. So
in some way, you're confident on the process that we are being in the middle of.
I think pretty much every Chilean I've met has been quite common sense and smart people. So I'm confident that you guys can come up with something that functions and doesn't ruin the economy or the country. Good
to hear. It's something that we need positivism. The locals are in some way much more depressed than the offshore investors, clearly. Okay, we are running out of time. We have a bunch of more questions, but just maybe to give you some minutes, maybe, I don't know if you would like to highlight some things, or maybe what are the main worries that you're seeing in the market right now? What makes you, I don't know, wake up and being worried off in your portfolio?
No, so I think one thing, not in the market, but on the fund, I think one thing that we've been able to do is to build up a very professional investment organization. And that is not necessarily easy within a government setting. You have to recruit people, you have to pay those people market salaries, etc. And it's sort of like it's not an easy task. We've been able to do it, and we've been sort of like been lucky to have very understanding politicians that have been very ingrained in the discussions around things, and the Ministry of Finance above there again, or above the fund, which is high quality people that understand what's going on, etc. But it's a risk, and I see that as like the longer term risk in a sense. We can easily become too bureaucratic. We can become stop paying market salaries and not get good enough quality people. That is very dangerous when you manage $1.3 billion. You know, small mistakes adds up to a lot of money. So that is going to be like a continuous uphill battle, and that's kind of like the one thing we worry about when we sort of set together an organization. Currently, we're able to attract people and we're able to hire people, and we have very good people, but it's a worry.
Mm-hmm. Clear. Just to understand, going on in the Chile situation, how frequent do you come to Chile? No, not in this environment, but let's talk about in normal times. Do you visit the countries? Do you meet the managers, or do you, I don't know, leave that to the final meeting at the end of the year? How do you relate to
No.
managers?
So we tend to see the manager 3 to 4 times a year in their office. Wow. So we travel a lot. Going forward, Zooms turn out to function quite well. So it might be in the future that it's 2 times in the office and 1 remote. But we're very, very interested in seeing managers in their office. It's just something walking through the premises, talking to people, sensing the environment. There's a lot of soft factors that goes into it. Seeing how people discuss things, how they talk together. So that's a very, very big thing for us.
Good.
And as I mentioned earlier, you know, the decisions are spread out very to individual people. It's not groups. So hiring external managers is the same thing. So my colleague Thomas is responsible for Chile, and it's 100% up to him what managers we have in Chile. And he will, you know, he can hire new managers, he can terminate managers based on basically if he believes they're going to create value going forward. Of course, we travel together, so it's not like we don't discuss on the team, but everyone knows that it's his decision. And you can only reach that decision point by sort of seeing people and visiting them.
I agree on that. So, Paul, I think that a little bit about to end. So just to thanks a lot to you, your time, your insights are really, really relevant for us. Thanks to the audience. There's a lot of people connected. And again, thanks to the sponsors, I have to mention them. It's Moneda, Sartor, Finsa, and Scotiabank. Many thanks to them as well. So the CFA local society, it's appreciate a lot the support on that. So many thanks, Paul, again, and we wish to see you again soon. Okay.
No, I'm hoping for it, and good luck in the football game.
No, we will do it. We will do it. Thank you very much.
Thank
you,
you.
Guys. Thank you.
Take care.
You too. Bye-bye.
Bye.